And our goal today, well, it's pretty straightforward. We've been digging through all of United Airlines Holdings, Inc.'s official reports, and, their annual filings, SEC documents, the lot.
A lot of reading.
Absolutely. To pull out the absolute must-know facts and maybe some surprising insights, we're basically trying to give you the ultimate cheat sheet to really get smart about where this airline stands financially.
That's right. And this isn't just about, their flight routes or the snacks they serve. It's a proper financial analysis of United Airlines Holdings, Inc., or UAL as we'll probably call it.
Yeah, UAL.
We'll be looking at its journey through some incredibly challenging recent years and its strategic path forward, all viewed through the lens of its financial statements. We'll trace its financial performance from, say, 2020 right up to the present day, dig into who owns a piece of the pie, and explore some key financial ratios that tell a pretty significant story about its health and, well, its strategic direction.
Okay, but before we unpack all of this detail, and there is a lot of detail, it's absolutely vital we say this up front.
Super important.
This discussion is a financial analysis purely for informational purposes. We are not financial advisors. Nothing we say today should ever be considered financial advice.
Nope.
It's crucial that you, the listener, always conduct your own thorough research. And please consult with a qualified financial professional before making any investment decisions.
Absolutely. Our mission here is just to equip you with a deeper understanding, not to guide your investments in any way. We're here to distill knowledge, not, predict the market or tell you what to buy.
Exactly. Knowledge distillation. I like that. All right, so United Airlines. When we think about them, we're really looking at a company with a pretty interesting evolution. Let's start with the structure. What's the significance of this holdings structure, United Airlines Holdings, Inc.? Is it just some legal thing, or does it tell us something deeper about how they operate?
That's a great place to start, actually, because it's definitely more than just a formality. The holdings designation, which, evolved from its continental past.
Right, I remember United Continental Holdings.
Exactly. That shift reflects a pretty common strategic corporate move. It means United Airlines Holdings, Inc., operates as the parent, the holding company, and its main wholly owned subsidiary is United Airlines, Inc. That's the airline most people think of.
Okay.
This parent subsidiary structure gives them significant strategic flexibility. For instance, it allows the holding company to manage diverse assets, maybe even different ventures down the line. And it can help compartmentalize risk. So if one subsidiary faces a big legal challenge or a financial issue, it can, well, theoretically, shield the parent company and other subsidiaries to some extent. It's a fairly sophisticated legal framework, really necessary for such a massive global enterprise.
And you can still see little echoes of its past identity, can't you? Like in some older corporate documents.
You can, yeah.
I noticed the United Continental Holdings, Inc., 2008 and 2017 incentive compensation plans. They clearly point to that former name before the current Holdings one. It's subtle, maybe, but it's an interesting historical clue. Reminds you that these huge corporations aren't static. They evolve. Mergers, rebranding, strategic shift.
Absolutely. It's like finding old blueprints for a modern building.
Yes.
You see the layers, the history of its construction, and how it changed over time.
And they have that shared purpose, connecting people, uniting the world. It sounds, well, profound. But how does that actually translate into a tangible business strategy? Or is it more of a brand statement, a nice slogan? Does it impact financial decisions?
That's where, the rubber meets the road. Well, it's definitely a marketing anchor, something to rally employees around.
Certainly.
For a company like United, it also acts as a kind of North Star for their long-term investments and strategic direction. Think about their really aggressive United Next plan.
We'll definitely get into that.
Right. That's not just about buying bigger planes. It's fundamentally about connecting more people to more places, more efficiently, more comfortably. That commitment to connectivity, it underpins their whole network expansion strategy.
Okay.
Financially, this means they're aiming for economies of scale, optimizing routes, trying to lock in market share in key global regions. All of that ultimately should bolster their revenue streams and hopefully reduce per unit costs. So, yeah, I'd say it's a strategic directive with pretty clear financial implications, not just, warm, fuzzy words.
Oh, okay, that makes sense. And speaking of their operations, United boasts the most comprehensive route network among North American carriers. That's not a small claim.
No, it's huge.
How does having such an extensive network, particularly with those strategic hubs, translate into a real competitive advantage? It's such a cutthroat industry.
It's absolutely fundamental, especially for a legacy carrier like United. Their operational backbone relies on those major U.S. mainland hubs. Chicago, Denver, Houston, L.A., Newark, San Francisco, Washington, D.C.
Right, the big ones.
Each one is a critical node. They facilitate connections across the country and, importantly, globally. This hub and spoke model lets them funnel passengers from smaller markets through these big airports, which means they can fill planes more efficiently and offer a wider range of destinations than, say, a point-to-point carrier might. This ideally leads to higher load factors, fuller planes, better utilization of their expensive assets like aircraft and gate space, and potentially stronger pricing power on popular routes. It's all about network effects, really. The more places you fly, the more valuable your network becomes to travelers. It creates a sort of virtuous cycle.
And it's not just their own network, right? They lean heavily on partnerships and alliances. United's a key member of the Star Alliance. That involves these bilateral commercial agreements. What's the practical value there for United and for passengers?
These partnerships are absolutely crucial. They expand global reach without the, frankly, enormous capital expenditure needed for purely organic growth. Being part of Star Alliance means agreements covering things like reciprocal frequent flyer mile earning and redemption.
Yeah, that's handy as a traveler.
Exactly. Passengers get more flexibility, more value. Your miles aren't just locked into one airline. Plus, you get access to airport lounges globally, which enhances the travel experience, especially for frequent flyers.
Okay.
And for United. It means they can offer pretty seamless travel to hundreds of destinations they don't actually fly to themselves. This attracts a broader customer base, helps them compete more effectively against other big global airline groups like oneworld or SkyTeam. It's a strategic way around some of the capital intensity of just buying more planes to fly everywhere.
But it's not just the Star Alliance, is it? I saw they also maintain independent alliance agreements with a whole range of other carriers. Aer Lingus, Emirates, Hawaiian Airlines, Virgin Australia. What's the thinking behind those agreements when they're already part of such a major global group?
That's a sharp observation. It really highlights a deliberate strategy to broaden their reach even further. These independent deals often fill specific geographic or market gaps that might not be fully covered by Star Alliance partners.
Okay.
For example, that agreement with Emirates, it lets United tap into Emirates' incredibly strong network in the Middle East and the Indian subcontinent. Areas where Star Alliance might not be as dominant, they get that access without needing Emirates to formally join the alliance.
Makes sense.
These partnerships offer more targeted market access. They allow United to offer unique routes or maybe more convenient connections to specific regions, even leisure destinations, that might not be core to the broader Star Alliance strategy. It gives them a layer of nimbleness, a focused expansion capability beyond the big alliance structure.
Okay, so they've built this vast interconnected web, both organically and through partnerships. But now we have to shift gears and talk about the financial journey, especially the major turbulence starting around 2020.
Yeah, you really can't discuss recent airline finance without diving deep into COVID-19.
Exactly. You just can't talk about the aviation industry's performance recently without starting there. The impact was unprecedented, particularly in 2020 and 2021, that first quarter of 2020. Demand just fell off a cliff, international, domestic, everything.
Almost overnight. It was staggering.
And the numbers reflect that. A $7.1 billion net loss in 2020, that's just monumental. How does a company the size of United even begin to cope with that kind of financial bleeding? And what role did government help play?
Well, cope is the right word. Survival mode kicked in. And that's where the CARES Act became absolutely critical. The demand collapse was, as you said, swift and brutal. It led directly to a material deterioration in revenues and those huge net losses. $7.1 billion in 2020. Things improved slightly in 2021, but still another net loss of nearly $2 billion, $1.96 billion, to be precise. These figures just vividly show the direct hit the whole sector took.
Right.
To weather that storm, the U.S. government stepped in with substantial support through the CARES Act. In 2020, UAL got about $7.7 billion, specifically through the Payroll Support Program, the PSP.
Okay.
And this wasn't just a blank check. It was a mix of a direct grant and an unsecured loan, all earmarked specifically for employee salaries and benefits through March 2021. The goal was basically to prevent mass layoffs and keep the industry's workforce intact, ready for an eventual recovery.
And that wasn't the end of the government support, was it?
No, precisely. There was more. An additional $2.6 billion came in 2021 through something called PSP2, again, a mix of a grant and a promissory note. And beyond the payroll support, the company also entered into an agreement for a big term loan facility, up to $7.5 billion available under the broader CARES Act loan program. They actually drew down $520 million of that in September 2020.
So, significant lifeline.
Absolutely crucial. These funds were vital for maintaining liquidity when revenue essentially evaporated. They ensured the airline could keep the lights on and eventually resume full operations. Honestly, without this government intervention, the financial landscape of the entire U.S. airline industry would look drastically different today. Many might not have survived.
But like most government aid, it wasn't free money. There were substantial strings attached, right? What kinds of restrictions did they face, and how did that influence their flexibility during that period?
You hit on a crucial point there. Accepting these funds came with very specific conditions, and they definitely influenced United's strategy. Key restrictions included limitations on paying dividends, so no returning capital to shareholders that way.
Okay.
Strict limits on share repurchases couldn't buy back their own stock to boost the price. Requirements to maintain certain service levels, ensuring essential air travel continued even with low demand.
Right.
And, critically, requirements to preserve employment levels through March 2021, directly linked to that payroll support. Plus, there were limitations on executive compensation. So these conditions significantly tied their hands financially and operationally. They were forced to prioritize survival and keeping people employed over, say, shareholder returns or aggressive strategic moves, at least in the immediate term.
Okay, so beyond just taking the government aid, UAL had to make some incredibly aggressive defensive moves themselves. What did those look like on the ground? How did they scramble to conserve cash?
They moved incredibly fast, really. Operationally, they undertook extensive schedule reductions, flying far fewer routes. They dramatically cut planned capital expenditures, pausing non-essential projects, and they slashed operating expenses across the board. Everything from reducing in-flight services to renegotiating supplier contracts. Financially, well, they terminated their share repurchase program, as required, but they also took on immense amounts of additional debt. In 2020 alone, they issued or entered into roughly $13.4 billion in secured notes, secured facilities, and new aircraft financings.
Wow, $13.4 billion in 1 year.
Huge numbers. On top of that, they raised about $2.1 billion by issuing new common stock, which, dilutes existing shareholders but brings in cash. And they borrowed another $1.08 billion from a revolving credit facility they already had access to. It was truly an all-out effort just to shore up liquidity, build a cash buffer.
They also had to make incredibly tough decisions about their workforce. I remember hearing about those WARN Act notices. Can you elaborate on the scale of that? And how did they manage to reduce the number of actual furloughs from the initial warnings?
It was a very stark moment, yeah. For the airline, and especially for its employees. In July 2020, about 36,000 employees received those WARN Act notices. That's basically an official heads up about potential mass layoffs or furloughs, a massive chunk of their workforce.
Huge number.
They managed to reduce the number of actual involuntary furloughs down to approximately 13,000 employees.
Still a lot, but much less than 36,000.
Still a terrible number, but significantly less than initially feared. It really highlights the immense pressure they were under, cut costs drastically, but also try to preserve as many jobs as possible, leaning on both that federal aid and internal flexibility programs.
One particularly striking financial move was the Mileage Plus financing in July 2020. United essentially mortgaged their crown jewel, their loyalty program. What does that tell us about the sheer desperation of that moment? Why was that a better option than, say, even more traditional debt or issuing more stock at those low prices?
It absolutely underscores the magnitude of the crisis. Leveraging Mileage Plus, issuing $3.8 billion in senior secured notes, and taking out a $3 billion term loan, both specifically secured by the assets of the loyalty program, was a major, major step. At that point, traditional debt markets were incredibly tight, maybe even closed off for airlines perceived as high risk. And issuing significant amounts of new stock would have been massively dilutive, given how low their share price had fallen.
Right.
The Mileage Plus program, though, was different. It has historically robust and predictable cash flows, largely independent of flight operations. People still use their co-branded credit cards. That made it unique, valuable collateral that was still attractive to lenders, even in that environment.
So as an asset they could borrow against when others weren't available?
Exactly. It was a way to secure billions in liquidity when few other options were really viable. But it definitely highlighted the extreme stress on their balance sheet and the lengths they had to go to pledging core assets. And what's really fascinating and risky about that deal, it included stringent covenants. The big risk was if United were to default on that specific debt, The lenders could potentially seize control of the entire Mileage Plus program. That would be catastrophic, not just for United, but potentially also for other creditors who might have previously viewed Mileage Plus as an unencumbered asset supporting the whole company. It shows just how far they were willing to go for survival.
Wow. Mortgaging the loyalty program really does underscore the pressure. Okay, so they got through that brutal period. What were the first signs of hope? How did United pivot from just pure survival mode towards actually looking to the future again?
Yeah, the shift, when it started, was pretty traumatic. 2022 really marked that pivotal turning point for the company and really for the whole industry. United achieved a net income of $739 million that year.
Back in black.
Exactly, a significant turnaround from those massive losses in 20 and 21. And management, in their reports, attributed this positive shift directly to the approval or widespread distribution of COVID-19 vaccines. That led to increased confidence, both from the public and within the industry, about the timing and strength of the air travel recovery. It wasn't just a tiny flicker of hope. It was a clear signal that the world was reopening, and people were really eager to fly again. Pent-up demand was huge.
And this return to profitability also coincided with a big strategic focus on the United Next plan, right? That was announced back in June 2021, but it really seemed to gain traction in 2022. It sounds like a really ambitious long-term vision. What does it actually involve? What are the core objectives?
The United Next plan is truly transformative for the airline. It's huge. It involves firm orders for initially 270 new aircraft, a significant mix, Boeing 787s for long haul, lots of 737 AMSs, and an Airbus A321neos, the longer range A321 XLRs, and even A350s eventually.
That's a lot of new metal.
It is, and the goal is multifaceted. 1, increase the number of mainline daily departures. 2, significantly boost the number of available seats across their North American network in particular. And 3, fundamentally modernize the fleet.
How does that help?
By replacing older, less efficient planes with new, often larger ones, they aim to increase what's called gauge, the average number of seats per flight. This improves fuel efficiency dramatically, lowers maintenance costs over time, and hopefully enhances the overall passenger experience with newer cabins and amenities. It's a strategic move to optimize their network, reduce their environmental footprint, which is increasingly important, and position themselves for long-term growth and competitiveness.
It sounds impressive, but it's also important to note, I guess, that a plan this ambitious relies on several key assumptions, right? About future demand staying strong, about Boeing and Airbus actually delivering these planes on time.
Absolutely.
And about having the necessary labor and stable supply chains. And we've already seen some bumps in the road there. Some Boeing 737 MAX and Airbus A321neo deliveries that were supposed to happen in 2023 got pushed into 2024. What are the implications of delays like that for such a complex multi-year plan?
Those delays can have significant ripple effects, absolutely, across the whole operation and the financial planning. First, there's the immediate financial impact. If you don't get your new super fuel-efficient plane on time, you have to keep operating an older, thirstier, more maintenance-heavy plane for longer.
Right. Costs stay higher.
Exactly. It directly hits your fuel expenses and your maintenance costs. Second, it impacts the network strategy. If those new planes were earmarked for specific new routes or for increasing capacity on existing ones, delays mean they might miss out on capturing market share during peak seasons, or they might have to trim schedules, which can frustrate customers. Third, it can create headaches for labor planning. Training pilots and crew for new aircraft types might get delayed or need rescheduling. So yeah, these delivery delays aren't just minor hiccups. They can impact revenue, operational efficiency, competitive positioning. It really underlines the sheer complexity of managing an airline's fleet strategy when you're dependent on just two major global suppliers.
And to support all this ongoing operations, plus the strategic plans like United Next United continued to issue debt, even in 2021 as things were starting to look up. You mentioned $5 billion from a term loan facility, $4 billion from secured notes, another $1.7 billion from those later PSP notes, and $600 million from EETCs, those Enhanced Equipment Trust Certificates. This constant reliance on debt really underscores how capital intensive this industry is.
That's a critical point to keep hammering home.
Yeah.
Airlines are inherently capital-intensive businesses. Unlike, say, a software company that mainly invests in people, airlines require colossal investments in physical assets. Aircraft, engines, ground equipment, hangars, airport facilities. We're talking multi-billion-dollar price tags.
Right.
Those ETCs you mentioned, they're specialized debt instruments used almost exclusively by airlines, specifically to finance aircraft purchases. They're basically secured by the aircraft themselves. making them attractive to certain investors.
Okay.
This constant need for financing means managing debt isn't just something they do occasionally. It's an ongoing central part of their financial strategy. It's not just about taking on debt, but managing its cost, its terms, its covenants, its maturity profile, all to ensure long-term stability.
Now, here's where things get really interesting, I think, especially looking towards the future. United's commitment to sustainable aviation fuel, or SF,
A hot topic.
definitely. And it isn't actually a brand new thing for them. Way back in 2015, UAL made a $30 million equity investment in a company called Fulcrum Bioenergy.
Right, focusing on turning waste into fuel.
Exactly. And then in 2016, they became the first airline globally, apparently, to use SF in regular operations. So thinking long-term strategy, what's United's real commitment here? Is this just, greenwashing, or is it a genuine potential game changer for their long-term financial picture and environmental impact?
That's the million-dollar question, isn't it?
Yeah.
Especially with all the focus on corporate sustainability now. Based on their actions, United's commitment appears quite genuine and seems pretty deeply integrated into their long-term strategy, rather than just surface-level greenwashing.
Why do you say that?
Well, that early investment in Fulcrum back in 2015, and being the first to use SF regularly in 2016, that shows a proactive, rather than purely reactive approach. They were looking at this years ago. Then there's their Eco Skies Alliance program, launched in 2021. That's quite innovative. Gets their corporate and cargo customers to chip in and collectively fund the price premium for SAF.
So helping cover the extra costs.
Exactly. SAF is currently much more expensive than traditional jet fuel. This program creates a market-based mechanism to help offset that cost and encourage more SAF use. It demonstrates a way to try and scale up adoption.
But there's always a but.
There is. Despite these efforts, the actual supply of SAF remains incredibly constrained. Tiny. Representing less than 0.1% of total global aviation fuel usage as of 2022.
Wow, less than 0.1%.
Yeah. So while the commitment seems real, and SAF is definitely a potential game changer for decarbonizing aviation, the massive challenge for the whole industry is scaling up production to meet the demand needed for these ambitious emissions reduction targets. It's a very long road, but United is clearly investing in those foundational steps.
Okay, shifting back to the balance sheet for a moment. Despite those huge losses in 2020 and 2021, management made a determination. They basically said these results were due to the unique, unprecedented pandemic impact and therefore weren't indicative of future results. And this allowed them generally not to record something called valuation allowances against their deferred tax assets, particularly those linked to pension obligations. What's the accounting significance of that decision? Sounds technical, but important.
It is technical, but it's a crucial accounting nuance that actually highlights management's forward-looking confidence at the time. Let me try to break it down. Deferred tax assets, like those related to pension obligations, are basically future tax benefits the company expects to receive. If a company has big net losses, like United did, it can sometimes carry those losses forward to offset future taxable income, which means paying less tax later. However, accounting rules say if management believes it's more likely than not that they won't have enough future taxable income to actually use those deferred tax assets, they have to record a valuation allowance against them. This essentially reduces the value of those assets on the balance sheet today and takes a hit to current earnings.
Right, so it makes the current financials look worse.
Exactly. So United's decision not to record these allowances, except for some specific minor items, indicated a strong belief, even amidst those losses, that the pandemic's impact was temporary. They believed the company would return to sufficient profitability in the future to fully utilize these tax benefits. It was a signal of management's optimism and conviction in the airline's eventual recovery, and it directly impacted their reported financial position at the time, keeping those assets on the books at full value.
Interesting. A sign of confidence baked into the accounting. Okay, let's move into the most recent data now, looking at continued growth but also evolving challenges from 2023 into 2024. The positive financial trajectory definitely continued. Net income hit $2.62 billion in 2023.
Strong year.
And then strengthened further to $3.15 billion in 2024. Operating cash flow also really improved significantly during this period. That shows robust recovery and good cash generation from just running the airline right.
It is indeed a dramatic comeback after those immense losses, seeing net income in the billions and strengthening operating cash flow that underscores the remarkable rebound in air travel demand and also United's success in capturing that demand. Operating cash flow is particularly key because it shows the cash generated from normal business activities before you account for things like depreciation or financing activities. Strong operating cash flow is absolutely essential for funding those big capital expenditures, servicing the debt, and investing in future growth.
However, the debt didn't vanish. The company still maintained a substantial amount, around $29.37 billion in 2023, and about $24.84 billion in 2024, and that's excluding unamortized discounts. This figure, while fluctuating a bit, still points to that inherently capital-intensive nature we discussed.
Debt is part of the airline DNA.
And they even borrowed more, an additional $2.8 billion through new term loans in 2024, with a 6.63% fixed interest rate, demonstrating ongoing financing needs, likely for those new planes. How does this continuous substantial debt load interact with that big United Next plan?
It's a direct reflection of it. The United Next plan and the airline industry's need for massive capital go hand in hand. That plan continued to progress, targeting the delivery of, ultimately, over 660 new aircraft by the end of 2033.
660, wow.
Each one represents a significant capital outlay, often hundreds of millions of dollars per plane. While these new aircraft promise better fuel efficiency, lower maintenance, better customer experience, they still need to be paid for.
Right.
So the ongoing debt issuance and that substantial debt load are inextricably linked to executing this ambitious fleet modernization. It's a constant balancing act. Invest heavily to improve future efficiency and competitiveness, but do so while carefully managing the cost of that capital, like that 6.63% interest rate, which at least gives them predictability on that chunk of debt, and managing the overall financial risk that comes with high leverage.
Okay, and alongside the financials, environmental sustainability efforts have also seemed to escalate. UAL set some really ambitious goals.
Yeah.
Reducing greenhouse gas emissions by 100% by 2050.
With the net zero goal.
And cutting carbon emission intensity by 50% by 2035 compared to 2019 levels. What are the practical and financial costs of trying to achieve goals like that for an airline? Is it just buying more SAF, or are there other big compliance challenges involved?
These are incredibly ambitious targets, yeah. And achieving them goes far beyond just buying SF, which, as we know, is still severely limited in supply and expensive. It involves substantial costs and a fundamental transition across a whole suite of technologies and operations. Well, beyond SHOTFAF, it means investing heavily in those new, more fuel-efficient aircraft. That's a big part of it. Optimizing flight paths, using better data and air traffic management, exploring operational efficiencies on the ground, and then longer term, potentially exploring electric or hydrogen propulsion, though those are still very much in the research and development phase for large commercial aircraft. And then there are the escalating compliance costs. Regulations like CORSIA, that's the Carbon Offsetting and Reduction Scheme for International Aviation. That's expected to require airlines like United to start purchasing carbon offsets, possibly by January 2028 if the final rules get locked in.
So paying for emissions they can't eliminate directly.
Essentially, yes. Buying credits to offset emissions. And it doesn't stop there. No. They anticipate increased operating costs from other regulations, too. The EU's emission trading system, the ETS, applies to flights within Europe. The US EPA and FAA are developing stricter standards for aircraft GHG emissions. Each new rule adds layers of complexity and cost. And then there's a whole other environmental issue emerging. PFAS chemicals.
Ah, the forever chemicals.
Exactly. Per and polyfluoroalkyl substances. They were recently designated as hazardous substances under CERCLA, the Superfund law, in April 2024. This is already leading to costs for airlines to convert fire suppression systems in their hangars and potentially on aircraft, as PFAS were common in firefighting foam. And there's also potential liability for historical usage and contamination. So it's really a multi-front battle. Huge investments in new tech, rising compliance costs, potential legacy liabilities, all aimed at decarbonizing a sector that's inherently very hard to decarbonize.
Okay, so beyond the financials and the environmental commitments, UAL also faces several emerging operational risks that could significantly impact the bottom line. Cybersecurity, for example. It's a constant battle for every big company, but what makes it particularly acute for an airline? Are we just talking about protecting customer data, or is there more to it?
Both. And that's precisely what makes it so critical for airlines. Obviously, there's the huge risk of a data breach involving millions of passenger records, names, addresses, payment info, frequent flyer details. The reputational damage from that alone can be immense, not to mention the potential for astronomical fines and legal costs. But beyond customer data, there's the operational risk. Imagine a cyber attack disrupting flight planning systems, ticketing and reservation systems, baggage handling logistics, or even ground operations coordination.
Yeah, that would cause chaos.
Exactly. Immediate delays, mass cancellations, huge revenue losses, and, worst case scenario, potential safety implications if critical operational or communication systems were compromised. Plus, the increasing use of AI applications for things like dynamic pricing, crew scheduling, predictive maintenance while offering efficiencies also potentially broadens the attack surface, creating new vulnerabilities that hackers might exploit. So, their ongoing investments in prevention, detection, and response tools aren't just about ticking a compliance box. They're absolutely fundamental to ensuring the very continuity and safety of their core operations.
Social media also presents its own unique set of challenges, doesn't it? It creates risks of brand damage, maybe accidental information leakage, even legal issues from inappropriate use by employees or customers posting things. How quickly can a social media misstep translate into real financial or reputational damage for an airline these days?
Almost instantaneously. That's the scary part. In the age of viral content, a single negative or inaccurate post, whether it's from a genuinely disgruntled customer sharing a bad experience, an employee making an ill-advised comment, or even misinformation spread by a third party, can explode online and significantly damage public perception and goodwill overnight. For an airline where trust, reliability, and safety are absolutely paramount, any perceived lapse captured on video or described in a viral tweet can lead to booking cancellations, loss of loyalty from valuable frequent flyers, and a serious dent in their brand value. Rebuilding that trust takes significant marketing spend and, more importantly, time.
Right.
And internally, inappropriate or unauthorized use of social media by employees can lead to leaks of proprietary information, compromise operational plans, or even lead to regulatory issues or legal action if sensitive data is exposed. It's a constant tightrope walk, managing that public interface and internal communication.
Another significant operational risk, and one I think many of us have probably experienced as travelers, is the antiquated U.S. air traffic control ATC system. It seems like it's constantly creaking at the seams. This poses risks of capacity constraints leading to delays, disruptions, especially during bad weather or peak travel times. How much of a financial drag is this outdated system for an airline like United?
It's a substantial and, I think, often underestimated financial drag. The current U.S. ATC system, largely based on decades-old technology, leads to significant inefficiencies that directly hit airline operations and profitability every single day.
How so?
Capacity constraints mean aircraft often get held on the ground waiting for clearance, burning fuel unnecessarily. Or they're forced to fly longer, less direct routes to avoid congested airspace, again burning more fuel and taking more time. This increases fuel consumption, a huge cost driver. It extends crew duty times, which has labor cost implications. And of course, it leads to passenger frustration due to delays and misconnections, which can require compensation payouts and damage future bookings. Every single delay, every inefficient routing has a measurable cost. Multiply that across thousands of flights a day, operated by a huge airline like United, and the cumulative financial impact is enormous. It limits their ability to maximize revenue, efficiently utilize their expensive fleet and crews. It's really a systemic risk that individual airlines can only mitigate so much through their own planning. They're constantly battling the limitations of the national infrastructure, hoping for modernization that always seems to be just over the horizon.
Human capital management dealing with their workforce is also critical for UAL. As of the end of 2024, something like 82% of their massive workforce, over 107,000 employees, were unionized. What are the financial implications of having such a highly unionized workforce in this industry?
That high percentage of unionization means that collective bargaining agreements, CBAs, are a very significant and often predictably increasing driver of labor costs for United. These agreements cover everything: salaries, health benefits, retirement plans, work rules, scheduling practices for pilots, flight attendants, mechanics, gate agents, ramp workers, most of the key employee groups.
Right.
Ongoing negotiations for new contracts, which happen cyclically, are generally expected to lead to material increases in salaries and benefits over time, directly impacting their operating expenses. That's just the reality of bargaining in the current environment. Furthermore, there's always the underlying risk of labor disputes. Things like strikes, work slowdowns, or other job actions remain a constant concern. A major strike, particularly involving pilots or mechanics, could completely cripple operations, leading to massive revenue losses, huge customer disruption, and substantial costs to recover afterwards. So managing labor relations effectively isn't just about keeping employees happy. It's absolutely fundamental to their financial stability and operational continuity.
And one last risk factor to touch on: antitrust litigation. It seems UAL is still involved in litigation stemming way back from a 2015 Department of Justice investigation. This was related to alleged collusion among major U.S. airlines on capacity, basically, accusations they coordinated to limit the number of seats available to keep fares high. The company is vigorously defending against class action lawsuits seeking something called treble damages. What exactly are treble damages, and what kind of financial liability could this potentially pose?
Treble damages are a particularly severe legal penalty, often available under U.S. antitrust laws. It means that if the plaintiffs, in this case, the passengers represented in the class action, are ultimately successful in proving that illegal collusion occurred and caused them harm, like paying higher fares,
Yeah.
the court can award damages equal to 3 times the actual estimated damages suffered.
Okay.
So hypothetically, if the alleged collusion was found to have caused, say, $1 billion in overcharges across the affected passengers, the airlines involved could collectively be liable for $3 billion.
Wow, triple.
Triple. It's designed as a major deterrent against anti-competitive behavior. So this represents a significant potential financial liability for United and the other airlines involved, which is precisely why they are vigorously defending against these lawsuits. Even if they ultimately win, these cases can drag on for years, incurring substantial legal fees along the way. And if a large judgment were rendered against them, it could have a material negative impact on their financial position. It's a kind of lingering legal cloud that investors definitely keep an eye on.
Okay, that covers a lot of the operational context and risks. Now let's get into our final segment: decoding ownership and key financial ratios. First, let's try to understand the ownership dynamics. We typically look at 2 main types, right? Insider ownership and institutional ownership.
That's right.
Insider ownership refers to the shares held by the company's own directors and top management. It's often seen as a signal of their confidence or lack thereof in the company's future performance because their own financial interests are directly tied to the stock price alongside other shareholders. This data usually comes from required SEC Form 4 filings where insiders report their trades. Now, while our source materials for today define what insider trading data is and where it comes from, they didn't actually contain the specific figures for UAL's current insider holdings or recent trading activity.
Correct. We don't have the exact percentages or buy-sell data in front of us from these reports. However, understanding this category is still crucial for getting a holistic view. High or increasing insider ownership can be a positive signal management, putting their own money where their mouth is, believing the stock is undervalued or has strong prospects. Conversely, if you see consistent heavy selling by multiple insiders beyond pre-planned sales for diversification or taxes, it might raise questions or warrant further investigation. So, even without the specific UAL numbers today, knowing that insider activity is a key metric for evaluating management's belief in their own company's future is important context.
Okay, then there's the other big category: institutional ownership. This represents the significant chunks of a company's stock held by large organizations, mutual funds, pension funds, hedge funds, university endowments, insurance companies, investment firms, etc.
The big players.
Exactly. Their substantial investments can definitely influence market stability, provide liquidity, and their buying or selling decisions often reflect a broader professional assessment of the company's prospects and valuation. This information is commonly found in required SEC Form 13F filings, where large institutions disclose their holdings quarterly.
And the materials we looked at did introduce several key metrics that these large institutional investors often use when evaluating companies and managing their portfolios. Things like beta.
Right, volatility versus the market.
Yeah, measures the stock's volatility compared to the overall market. A beta of 1 means it tends to move with the market. Above 1, more volatile. Below 1, less volatile.
Wow.
Then there's CAGR, the compounded annual growth rate. Basically, average annual growth rate of an investment over a specific period longer than a year. Max drawdown, which measures the biggest peak to trough drop in investment experience, is kind of a worst case loss scenario from a high point. And the Sharpe ratio, which is really important, it assesses risk-adjusted return. Essentially, how much return are you getting for the level of risk you're taking?
Okay.
Now, similar to the insider data, our sources for this financial analysis introduce these concepts and metrics that institutions use, but they don't actually provide the specific institutional ownership percentages for UAL itself, or how UAL stacks up on these metrics currently. But knowing these are the kinds of tools the big money managers use to analyze companies like United is important background.
Definitely. Okay, next, let's dive into deciphering some specific trailing 12 months or TTM financial ratios. Just a quick note on calculation first. It's important to remember that calculating some common TTM ratios, like price to earnings, PE, or price to book, PB, requires the current market stock price.
Right, which we don't have in these historical financial statements.
Exactly. That data isn't in our source material here, which focuses on the company's filings. So we'll focus on ratios where both the numerator and the denominator can be found directly within UAL's annual financial statements that we reviewed. Let's start with return on equity, or ROE.
Okay.
This ratio measures how much profit a company generates for each dollar of shareholder equity. It's a really key indicator of financial performance and how efficiently management is using the money shareholders have invested in the company. And United's ROE journey through these recent years tells a very, very clear story of recovery.
It certainly does. It's quite dramatic. If you look at 2020, they had that huge net loss of $7,067 million, and their total stockholders' equity at year-end was $5,960 million. A net loss means your ROE is significantly negative. It shows shareholder capital was actually being eroded, not generating returns.
Right.
2021, same story basically. Another net loss, $1,962 million, against slightly lower equity of $4,998 million. So continued negative ROE. No surprise, really, given the ongoing pandemic impact.
But then came the turnaround we talked about.
Indeed. In 2022, they swung back to a net income of $739 million. With total equity at $6,865 million, that yielded an ROE of approximately 10.76%. That was the first clear positive signal they were effectively deploying shareholder capital again to generate profit.
And it got better from there.
Much better. The positive trend accelerated dramatically in 2023. Net income jumped to $2,620 million, while equity stayed around $6,865 million. And most recently, for 2024, net income was $3,151 million against equity of $7,377 million. That resulted in an ROE of approximately 42.71%. This dramatic swing from deeply negative numbers to a robustly positive ROE in the 40s, it really highlights UAL's successful financial recovery and a much improved efficiency in leveraging equity to generate profits post-pandemic.
How does an ROE like 40% compare? Is that typical?
For most mature industries, a consistent ROE in the double digits, say 10-15%, is considered pretty good. Getting over 40% for an airline, even in a recovery year, signals exceptional profitability relative to the equity base at that moment. It's a testament to the strength of the travel rebound and their execution in capturing that demand and managing costs effectively, especially considering where they were just 2 years prior.
That is a powerful swing. Okay, moving on to return on assets, or ROA. This ratio indicates how efficiently a company uses its total assets, not just equity, to generate earnings, and it's particularly relevant for capital-intensive industries like airlines, with all those expensive planes and facilities.
Right, ROA gives you a sense of how well management is sweating those assets. And similar to ROE, UAL's ROA path reflects that challenging period of the recovery. In 2020, net loss of $7,067 million on total assets of $59,548 million resulted in a negative ROA. 2021, another net loss, $1,962 million on even higher total assets, $60,147 million, likely due to taking on more leased assets or debt-funded purchases, showing continued negative asset utilization efficiency.
Okay.
The recovery began to show in 2022. Net income of $739 million on total assets of $67,329 million meant the ROA turned positive, but just barely at approximately 1.9%.
Okay.
But then, like ROE, it improved significantly. By 2023, net income of $2,620 million on total assets of $73,777 million resulted in an ROA of approximately 4.27%.
So a steady improvement there, too.
Yes. The improving ROA signifies UAL's enhanced ability to generate revenue and profit from its extensive asset base, including that growing fleet of aircraft. It indicates they're getting more effective use out of their considerable investments.
How good is an ROA of around 4.27% for an airline?
For a capital-intensive business like an airline, where the A in ROA, assets, is enormous, an ROA in the 4-5% range is actually quite respectable, especially considering the scale of their asset base and the historically razor-thin margins airlines often operate on. It tells you they're not just accumulating planes, they're deploying them effectively enough to generate a decent return on that massive investment.
And given the huge investment in United Next and their focus on newer, more efficient aircraft, you might expect that ROA to hopefully continue climbing, right? Assuming they deploy those new assets effectively. Does it suggest they're getting good utilization out of the fleet?
Precisely. And improving ROA, particularly as newer, more fuel-efficient, and potentially higher revenue-generating aircraft come online, should suggest better asset utilization and cost control. It's a strong sign, or at least the goal, that their massive capital expenditures are translating into improved operational efficiency and profitability. That's a critical signal for investors looking at long-term viability in this tough industry. It shows they're not just acquiring assets, but ideally making them work harder for the company.
Okay, finally, let's look at the debt to equity, or DE ratio. We've talked a lot about debt. This ratio reveals the proportion of a company's financing that comes from debt compared to the financing that comes from shareholders' equity. A higher ratio indicates greater financial leverage, using more debt, which can amplify returns but also increases financial risk. And as we've established, high leverage is pretty common in this sector.
Very common. And UAL's DE snapshot consistently shows this high reliance on debt, which is indeed typical for airlines due to those massive aircraft purchases and other infrastructure investments. Let's look at the numbers we can calculate from the balance sheets.
Okay.
In 2020, the ratio was approximately 8.99. That's calculated from roughly $53,588 million in total liabilities, divided by $5,960 million in total stockholders' equity.
So almost 9 times more debt than equity?
Exactly. And it spiked dramatically in 2021, jumping to about 12.63. That was $63,149 million in liabilities over only $4,998 million in equity. Now, that clearly reflects the significant pandemic-related debt they took on just to survive, combined with the fact that their equity base shrank due to the huge losses.
Right. The denominator got smaller and the numerator got bigger.
Precisely. Now, the ratio then moderated slightly in the following years as profitability returned and equity rebuilt somewhat, but it remained substantial. In 2022, it was back down to approximately 8.81. $60,464 million liabilities, $6,865 million equity. And crucially, their debt agreements include financial covenants. These are contractual promises they make to their lenders. The reports mention requirements like maintaining at least $2.0 billion in unrestricted liquidity, basically, cash and easily accessible funds, and maintaining a minimum ratio of the appraised value of collateral, like planes, to the outstanding secured debt against it, often something like 1.6 to 1.0.
So they have to keep a certain amount of cash on hand and ensure their pledged assets maintain value?
Exactly. These covenants are critical guardrails for managing risk and ensuring financial stability within such a heavily leveraged structure. If United were to breach these covenants, let their cash dip too low, or the value of their collateral fall too much relative to the debt, it could trigger serious consequences, potentially allowing lenders to demand early repayment, which could be disastrous. So these high debt ratios aren't just abstract numbers. They come with very real and tight financial management requirements.
That's really important context. Okay, beyond these core ratios, there are a few other financial dynamics mentioned in the reports that seem crucial to understanding UAL. Revenue streams, for instance, primarily passenger, cargo, and something called other operating revenue. You mentioned that co-brand agreement with JP Morgan Chase for the Mileage Plus credit card falls under other. That sounds like a massive deal. Can you break down how that actually works? Is it just United selling miles in bulk to Chase?
It's a good way to think about it initially, but yeah, it's more sophisticated and incredibly important. That co-brand agreement with Chase for the Mileage Plus credit cards is a substantial and hugely significant contract for United. It's a cornerstone of that other operating revenue.
Okay.
Think of it this way. Chase effectively buys Mileage Plus miles from United in massive quantities at a negotiated rate. Chase then issues these miles to their credit card holders as rewards for spending on the co-branded cards.
Right. Standard airline card setup.
But United's revenue recognition from this deal is more complex than just a simple bulk sale of miles. They also get recognized revenue for the marketing and advertising services they provide to promote the co-branded card itself, helping Chase attract new cardholders who will spend money.
Okay.
And critically, they allocate a portion of the payment from Chase as revenue recognized over time for the estimated value of the travel-related benefits that cardholders receive directly from United just for having the card. Things like waived baggage fees, priority boarding, potential seat upgrades, airport lounge passes. So it's not just a one-off sale of miles. It's treated as a multifaceted bundle of performance obligations. The miles themselves, the marketing support, the ongoing travel benefits. This structure makes it a remarkably lucrative, stable, and relatively high-margin recurring revenue stream for United. Credit card revenue tends to be much more consistent and predictable, driven by consumer spending habits. It's often referred to as an airline's hidden gem because it provides this steady cash flow, somewhat independent of actual flight activity. It's a really important part of their financial health.
Interesting. Okay, another major factor, capital commitments. We know UAL has these substantial firm commitments to purchase hundreds of aircraft from both Boeing and Airbus, stretching way out through 2033, covering all those models we discussed. These commitments represent immense future capital outlays. How are deals like that typically financed, and what does this imply for United's financial health moving forward?
These commitments are indeed staggering. Billions and billions of dollars in future spending locked in. They're typically financed through a mix of methods. We mentioned EETC's Enhanced Equipment Trust Certificates, which allow them to borrow against the specific aircraft being purchased, often at favorable rates because the debt is secured by a movable asset.
Okay.
They also use direct corporate debt, secured or unsecured term loans, and various types of leases, both operating leases like renting and finance leases, closer to ownership with debt characteristics. The sheer scale of these commitments means United will continue to be a highly capital-intensive company for the foreseeable future. They'll remain heavily reliant on accessing the debt markets consistently and managing that debt effectively. It clearly indicates a long-term growth and modernization strategy, but it also locks in a persistent need for robust cash flow generation just to service the resulting debt and fund the future acquisitions as they come due. It's a huge long-term investment that shapes their financial structure for years, even decades to come.
The company also carries these ongoing substantial obligations related to pensions and other post-retirement benefits, like healthcare for retirees. These require significant future contributions. How big of a factor are these legacy liabilities?
They are a significant factor, yes. These are promises made to employees, often over many decades of service, and they represent a substantial fixed cost base that has to be funded. For a company like United, with a long history and a large, heavily unionized workforce, managing these pension and post-retirement obligations requires constant actuarial assessments to estimate the future liability, and then making substantial cash contributions each year to dedicated trusts to fund them. These are generally non-negotiable liabilities. If they become significantly mismanaged or underfunded, perhaps due to poor investment returns in the pension funds or inaccurate assumptions, they can create a huge financial burden on the company, impacting its free cash flow, its credit rating, and its profitability for a very long time. It's a major long-term liability that requires constant monitoring and prudent financial planning by management.
Okay, and finally, one last critical sensitivity mentioned, aircraft fuel prices. Unsurprisingly, UAL's operations are highly sensitive to fuel price fluctuations. As of their 2024 filing, the company stated its policy is generally not to hedge fuel price volatility. They're basically riding the market waves. The filing even put a number on it. A $1 change in the price of a barrel of crude oil was projected to impact its 2024 fuel expense by approximately $100 million. What are the implications of having this no hedging policy?
This is a pretty bold and some would say risky policy choice in the airline industry. Many, if not most, major airlines use fuel hedging strategies to some extent. They use financial instruments like futures contracts or options to lock in fuel prices in advance, aiming to create more predictability in the largest variable cost and shield themselves from sudden sharp price spikes.
Right.
United's decision generally not to hedge means they take the full brunt of market fluctuations, for better or worse. On the upside, if fuel prices unexpectedly drop, they benefit immediately and fully, experiencing lower operating costs than maybe a heavily hedged competitor. On the downside, however, if prices spike due to geopolitical events, supply disruptions, refinery issues, United's fuel costs rise directly and substantially, potentially much faster than a hedged competitor's. That $100 million impact for just a $1 change in a barrel really underscores the immense leverage even small price movements can have on their bottom line when you consume billions of gallons a year.
So what's the implication?
The main implication is a higher degree of volatility and risk embedded in their operating expenses. Their profitability becomes more sensitive to a major cost factor that's largely outside their direct control. Their strategy seems to rely more on their ability to quickly adjust fares to pass through higher fuel costs to consumers, or simply absorbing the hit to their margins if competitive pressures prevent fare hikes, rather than using financial instruments to mitigate the price volatility itself. It's a strategic choice with clear risk-reward trade-offs.
We have certainly embarked on a truly comprehensive financial analysis of United Airlines Holdings, Inc. today. We've traced its path from the absolute depths of those pandemic losses in 2020 and 2021.
Dark days.
to its impressive return to profitability and those ambitious strategic expansion plans in 2022, 23, and 24. We've seen how critical government support was, how aggressive cost-cutting played a role, and how plans like United Next are shaping its financial statements now. We've also touched on its commitments to sustainability, the complex ownership picture, and those key financial health indicators.
And the so what of all this analysis, really, is that hopefully it helps you, the listener, move beyond just the superficial headlines of the flight experience to understand the underlying mechanics of how a major global airline actually operates financially. It vividly reveals the kind of resilience required to navigate unforeseen global shocks like a pandemic. It highlights the immense capital demands of just staying competitive through fleet modernization. And it shows that delicate, constant balancing act between managing significant debt loads and pursuing ambitious goals for growth and increasingly environmental responsibility. You should now have a much more informed perspective on the strategic levers being pulled and the complex financial realities driving a company whose stated purpose is connecting the world.
Which brings us to our final provocative thought for you to consider as you digest all this. As UAL continues to invest so heavily in its future fleet and in nascent technologies like sustainable aviation fuel, how will the long-term interplay between these massive ongoing capital expenditures, its already substantial debt load, and the ever-present volatility of the global economy, fuel prices, and maybe even unforeseen geopolitical events? How will all that shape its competitive edge and its long-term shareholder value over the next decade?
Yeah, and what unexpected factors might emerge? Another global event. A sudden technological leap in propulsion or fuel that disrupts everyone's plans. What could challenge the carefully laid strategies we've discussed today? Lots to think about.
Definitely. And one last time, we absolutely have to reiterate.
Please remember.
This discussion has been purely for educational and informational purposes. It is not in any way financial advice. We strongly urge you to conduct your own extensive research and always consult with qualified financial experts before making any investment decisions based on anything you hear here or anywhere else.
Couldn't say it better. Do your own homework.
Thank you so much for joining us on this deep dive financial analysis. We hope you feel more informed and better equipped to understand the intricate financial landscape of United Airlines Holdings, Inc. Until next time.